Just understand this. If your money is in the money market, you have not started investing. It is just in the parking lot. Are we together? So you are just maintaining the level of that money, but it has not started earning anything. Now, if you start investing the money, now open your phone and get to and write in the Google. You write CIS Q4 report. Just enter kwa system yako, kwa simu yako. CIS Q4. CIS Q4 report. CIS Q4 report.
CIS Q4.
So what comes there? Q4, that is 2024, 2025, whichever 2020, something that you can write. What comes there? So now, in the CIS is what we call corrective investment schemes. Corrective investment schemes. Corrective investment schemes. That portal that you will be opening, it's a website of the Capital Markets Authority. And the Capital Markets Authority, when you are investing, Capital Markets Authority licenses the people who are going to do a corrective investment scheme. Corrective investment scheme is when you bring your money in the basket, another person brings, and so all of us bring that money together in that basket, and that is why it is called a corrective investment scheme. Now, corrective investment schemes, there are many in this country. And if you went to the right place, I want to get there. If you went to the right place, you will find there are many companies that have been listed up there as the approved CIS providers. CIS providers. So, the Capital Markets Authority, and this must be the beginning. Don't just go to an investment because you hear people are investing somewhere. So and so. And so if you have gone to the right account, you find people like Sanlam, Standard Investment Bank, the CIC, the MCBA, the Britam unit, the Old Mutual, the ABSA, the ICA, the Cooperative unit, the Jubilee, and there will be what we call the asset under management. The asset under management is the amount or the total amount that this CIS provider is managing. Now, when you come to that, if any person is providing an investment product in this country and is not listed in the CIS account, do not go for it. Why? Because nobody is providing security for that money. And so, the first line of defense for any investor in this country is the Capital Market Authority. Find yourself there and look what is there, and when you have looked what is there, now you can effectively be able to bring your money from the parking lot and take it into an investment. Now, if you will not be able to invest in a CIS account, now you can be able to invest in what we call the popular that we call the bonds and the treasury bills. Now, treasury bills are not investments, they are liquidity tools. You see, they are liquidity tools because you want some form of liquidity. And actually, the treasury bills are not meant for an investor, they are meant for an institution to keep money somewhere awaiting. Maybe they are going to pay dividends, maybe they are going to pay the loans, maybe they are going to pay certain obligation. That is how you get your money into the treasury bills. And that is why the treasury bill rate of return is usually very low and very moderate. Any investment in this country that has a rate lower than the treasury bill return rate, then it is an area that you must never invest in. Because the TB rate is what we call the risk-free rate. You know, the risk-free rate is the rate in which that you can take your money to the government, they can be able to borrow that money, and then that money can be able to earn you that amount. And so it is like a benchmark telling you the minimum that you can earn in this country is the T-bill rate. And so any asset that you are evaluating or area of investment that you are evaluating must be, not maybe, must be above the treasury bill rate. Now, you may not invest in the treasury bill. The treasury bills usually, because they are liquidity tools, they will give you 90 days, 180 days, and 360. The longest one will be 360 days, or about 1 year. They are not sold at a rate that is bigger, they are sold at a discount. Are we together? So if you are buying a treasury bill, you will be told now you have a treasury bill worth 100 shillings, but you will pay 96 shillings. So when the time comes, 180 days or 90 days comes to an end, now the Central Bank of Kenya will be able to refund you the 100, but you paid the 96, and so your margin is what is taken as the return. This is contrary to the bonds. The bond market is diverse. What is a bond? A bond is a debt instrument. You are ready to either a nation or you are ready to corporate. When you are ready to the nation, they are called the bonds. When you are ready to a corporation, like breweries, they are called corporate bonds. The concept is the same. All of them are debt instruments. Now, bonds, they depend with the purpose which the bond was created for. Now, we have FXD bonds, fixed rate bonds. This is the normal bond. If you go to a bond paper and you find it is written FXD, that means this is a fixed rate bond where the rate is fixed at a certain rate, and it is meant for just the general working of the population. Now, there is the SDB, the Saving Development Bond. Now, the fixed rate bond is for the commercial. The Saving Development Bond, it comes with some strategic advantages. Their risks, not very much, because currently I think the rate of saving in this country is 11%. It is only 11 people out of 100 people in this country who are saving. What are the others doing? What are the others doing? Yeah, so they are doing exactly that. And so the government to encourage saving, they bring the saving development board. And when you will ever see an SDP board, go for it. It is a better board than an FXD board. Are we together? Now there is the final one. or the bigger one that many people know, that is called the IFX bond, the infrastructure bond. The infrastructure bond has more advantage than the saving development. Because they are infrastructure, the income that comes out of the infrastructure bond is not taxed. So at the end of the day, you get a better return when you are using an infrastructure bond than the saving development bond or a fixed rate bond.
Mhm.
Now, the other day when we were making the Taranta study, we issued a green bond. You see, a green bond, or a bond that was meant to develop such facility. And because of the global warming, the central bank will issue such bonds as often as they need. However, what you need to look for if you enter into the bond market, it is whether the name is starting with an F, with an S, or with an I.
Hmm?
Are we together? So, if it is starting with an X, it is a fixed rate bond.
Mhm.
If it is starting with an X, it is a saving development bond. If it is starting with an I, it is an infrastructure bond. And you go in that sequence. Start with the infrastructure, come with the saving, and then go to the fixed rate bond. That is how they are rated, and that is how they are advantageous. Bonds can range from a minimum of 5 years to about 50 years. And so, while we are saying that it is an investment, it is because every 6 months you get a return. It is called a coupon rate. A coupon rate, out of the amount, if the bond, and most of the bond that we are having is about around 12% going up there. So the 12% you are paid twice in a year. 6% after 6 months and 6% after 6 months. Now, after half price of that bond, if the bond was for 10 years, then after half price, 5 years, you are given, the government pays half of the amount of the bond. Now, in this market, bond market and the treasury bill market, there was an issue some years ago. Why? Because people could not be able to trade the bond. They were not volatile. And so, Nairobi Stock Exchange was changed or was reorganized so that we can have Nairobi Stock and Security Exchange. Initially, it was NSE, but now it is NSSE. So that it can be able, you as a person who have bond that you have carried for a number of years, and you want to sell that bond, you can go to Nairobi Stock Exchange and sell it through your broker. If it is a treasury bill and you get a financial challenge, you can go to the central bank discounting window and it can be discounted. Now, I was just explaining the government. If it is a corporate bond, last year in November, we had Kenya Brewers. It gave a corporate bond of about, I think, 20 billion to the market. And it sold about 16.69 billion. The rate was 11.8, I think 11.8%. And it was a 5 year bond. That was a very attractive investment avenue that anybody could have done because when it comes to investment, it's about the return, about how fast you can be able to get that. Now, to attend the government and the corporate, let us go to where I read the CIS, the corrective investment schemes. In the corrective investment schemes, there is something that we call an exchange traded fund, ETF, an exchange traded fund. An exchange traded fund is a financial asset or a financial instrument that trades overseas and gives you a return. You can go and look at the definition. Now, we have two companies that are competing in this market. One of them is the Standard Investment Bank with their product that is called Mansa X. It is a very popular product. The Mansa X is an ETF, is an exchange traded fund. The other exchange traded fund you have seen is from the double capitals, that is the oak fund. You have seen in the papers, the oak funds. Now, how does these funds operate? The funds operate by, now, the money market, you are supposed to invest more than 70% of the money market fund in this economy. In an exchange traded fund, you are supposed to invest more than 70% outside this economy. You get the difference?
No.
You get the difference? The money market, anybody providing money market, 70% of that fund is invested locally. In an exchange traded fund, 70% of that fund is traded outside. What does that mean? It means two things. The trading outside, when you bring that money in, you get concession because you are bringing foreign exchange to the country. When you are doing the money market, you are charged because you are fishing from the same basket. Are we together? So investing in an exchange traded fund is much easier and much better. But people have their own notion on the balance between risk and return. But investing in an exchange traded fund is a much more lucrative way of investing than investing in a money market. Are we together? And I think, as far as we are concerned, even last year, like the ATF Musa account was returning about 20.09%, something like that. Something that locally we were not able to gain anywhere in the country. Now, when you look at how you are able to invest, the other thing, let me tell you, there are critical mistakes Kenyans have done in investing, and especially in this tool that I'm going to talk about, the shares. Because those are government, these are corporate, these are exchange traded, but you can also trade in shares. Now, how do you trade on shares? You can trade on shares. You can go to Nairobi Stock and Securities Exchange, buy shares from your broker. Or number two, there is something that is called an IPO, initial public offer. Now, the NSE is meant for you as a retail investor. The IPO, and take this to the bank, it is not meant for you. You get me? It is advertised everywhere. It is marketed everywhere, but it is not meant for you. Why? Why do we invest in shares? Investing in shares is number one for strategic purposes. We had an IPO the other day, and it last month. Yeah, the Kenya pipeline.
Yes.
Who bought the shares? The Ugandan government. And not the Ugandan government, the president of Uganda. What was the selling price? 9 shillings. What was the payback period? The return? Around how many years? 22 years. Does that serve any retail person? Zero. The government there was investing for a strategic reason. Why? Because the government of Uganda is doing some oil somewhere and it will need that oil to be wired down for the cleaning up in the refinery in Mombasa. Then you, with your 900 shillings, you think to go and buy it. The second person who buys that, the IPO is for commission purposes. Now, if I am a provider and I have 15% of the shares of a company, do I have a bargaining power or don't I have a bargaining power? You see, so that bargaining power will be used to secure contracts. Are we together? Secure contracts and secure the concessions. And that is why sometimes you wonder that we were told that that whole bill, it gave, there was an oversubscription of about 284%. Not from you, not from an ordinary investor who is waiting for dividends at the end of the year. Didn't we buy already? Still we buy. We bought them. Did we buy Safaricom?
Yes.
How much do you get in return? Do you think it is an investment? It was not meant for you. And so when you are investing, look for an asset class that is meant for a retail investor. Do not go for what was meant for a wholesale investor, because at the end of the day, you won't be able to make anything. Now, two things or two words that are very important as far as investment is concerned. And when my time is over, just tell me. Two things that are very important and words that are important in investment. One is what we call consistency. Your ability to consistently invest, that makes a difference. Number two, time. You have to give yourself time. If you are not ready to give yourself time, investment may turn around 5 years or so. It may be between 5 and 10 years. But anything that is moral, that will you have not put some good amount, then it will be from that other side. So I have talked about the CIS. I have talked about the exchange traded funds. I have talked about the shares. And then I want to speak about something that is called commercial paper. There is something that we call commercial paper. A commercial paper is an investment or a debt instrument. It is not just issued by, 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 by companies that are not there. And a commercial paper, let me combine it with a private placement. Now, if you know, you know. When a company is about to go to public issue, it does what is called private placement. Currently, we are having Family Bank. Family Bank is planning to go on public, I think in the course of this year. And so you can go to Family Bank. They are selling the shares at, I think, Kenya shillings 16.54, 16 shillings and 54 cents. And the advantage of that, if you are able to go and buy privately, there, understand number one, you will not be able to trade that share in a stock exchange because this is a private residence. But when the IPO comes, that share balloons, and most of the companies that do share split, they split the shares. You see, so that initial share you have is given like 5 or 6 shares. So when the IPO is offering, and remember this, even if you hear about IPO, according to the Capital Markets Authority, you can only sell to the stock exchange or to the public only 20% of your share capital. Tuko pamoja? What can be traded to the public? Like Safaricom. Who owns Safaricom? Vodacom. Sini Vodacom owns about 51%. Sindio. The rest, about 30 or so, is owned by the government of Kenya. The 20% is owned by you. Do you think you have any influence over any decision that is made? The 20% is divided over 10 million people. You and me and the other person. And that is why sometimes it is always good and important to invest where you have an influence. Where is that? This is what made circles to come, which are called saving and credit cooperative societies. Saving and credit cooperative societies, you have a say on how everything is managed. Are we together? Yes. Saving and credit cooperatives, all societies, they are in turn shared amongst the members. Sindio? However high the charges are, at the end of the day, it will still come back to you in one form or the other. And that is why the people who could not do wholesale investment, they found a very important avenue called the circles. Now, the problem comes here. Circles have a challenge. And this is the challenge of management. Because when we come together, you find most of the circles and the officers are here. We elect members on either political basis or who knows who. Sindio? When it comes to the bank, which deals with the financial intermediation, you get to the bank on the basis of your competency. Sindio? And you are employed on the power of your papers. But in circles, this is the only financial institution you find led by non-financial people. Not this circle, not our circle, not in a circle, because you find even at the very rural areas, there is also a what? A circle. You see? And so now, what's the purpose of the circles? The purpose of the circle, number one, was to build their capacity to manage. So even if we elect whoever, he must get exposure so that they can rise the level. Because I said at the beginning, any institution is as good as the quality of its members. Not leadership.
Members.
Its members. Because it is the members that leadership comes from. Are we together?
Sure.
And that is why in any circle, there must be a budget of training. There must be a budget of education. There must be a budget that enhances the capacity because we acknowledge tumekuja pamoja, not that we are financial people, but we want to deal with the finances. Are we together? And so we borrow a lot. We must borrow a lot. We must invest time a lot so that we can become much better. Now, the other challenge is, and this is what the circle world has been dealing with. A circle like this PCA housing can buy a bank, but a bank cannot buy. Are we together? A circle can buy a bank, but a bank cannot buy a circle. What does that say? This is the challenge we have. The bank goes to the clearing house. So if we have a check, we have to deposit it in a bank for the bank to go and clear it on our. Who owns the bank? 4 people, 5 people, 6 people, 7 people. If they go many, they are 10 people. They created an avenue of earning, or the system created an avenue of you, circle, serving the interest of the banks. And that is the challenge of the financial world. And that is where we need to come in. And I think the circle, the commissioner have applied severally so that even circles can get access to the clearing house, that they can be able to get that portion of income. And so now, what do I want to say when I start here? I want to say 2 or 3 things. Number one, when you are investing, look, the first place you have to go is the capital markets authority. Are we together? Look whether that company that is offering that product is there and the nature of that product. The other day, people went to crypto. They went to cryptocurrency. And they were told that crypto is good, is high. Some went to Bitcoin, some they went to Tether. Whichever you went. Any investment is backed up by a value. Crypto is not backed up. And that is why the central bank issued 2 circulars. On the basis of the Bitcoins and whatever. Because what is a legal tender? There is an authority that issues something for it to become a legal. Bitcoins are issued by companies, and so They are not legal tenders. When you invest in something that does not qualify to be a legal tender and have no backing of institutions, then most of the time you are a billionaire today. In the next 2 hours, the billions are gone. Any investor, and I like South African investors, any company that is owned by South African and it makes interest more than 10%, the manager anafutwa kazi. That's the truth. Why? Because of the following reasons. Investment should go on a normal curve. A normal curve, any investor is looking for consistency of growth. Any investor is looking for surety of what he got last year, everything will be consistent. Are we together? So what happens in this year when we make more money, what we call windfall gains? Last year we had that opportunity where even the treasury bills and bonds went as high as 16%. Sindio? Everything was going to 19%. And in the same case, the what? The NSSF, they declared what? 17%. But they had made 24%. The previous year, they had given a minus 2%. Then this year, they give 17%. What do you think we will issue in 2026? The rate of interest are down. Where they had invested, the government is no longer borrowing. If they will go back to where they were, 10. A little investor do not want shocks. They don't have enough shock absorbers. Ati last year tulipatiwa 20. Alafu this year tunaambiwa 85%. Everybody will just go away. Not because they had a problem, but because the consistency of any investment was not taken into account. Are we together? And so we wait for that category of that consistency to go. And so, my dear brothers and sisters, cryptocurrency, unless you are an aggressive what? Investor, and you don't worry about your life, go ahead and do what? And invest, get the shocks and whatever. But for any Presbyterian worker, I think these are not the things that we do. Now, let me talk about an issue that has been mentioned by the chair here about the economy and how we invest in land. The reason why investing in land is very good. Actually, many billionaires in the world have been made from the real estate. Many billionaires have been made by the real estate. But the real estate is not a fast-moving consumer good market. And so the turnover is not as fast. And the release of the return is also not as fast. Let me give you an overview of what happened in this country. The pilots, mnakumbuka wakati wa Kibaki? The pilots, the Somalis, and the pilots, they wanted to print their money. They came and bought. Tunaona hizi gara, whatever, huko. Tunaona how a lot of the World Bank wrote a report and said, no. Nairobi, they are consuming pirate money. What did that do? It erodes the value of land in Nairobi. Buildings were made in Nairobi. Real estate, we thought we were growing, but we were not growing naturally. We were growing from the negative side. Because this was a forced growth, it was not a normal growth. Now what has happened? The space in Nairobi you'll find, most of the houses in Nairobi, two things have happened. The occupancy is about 40-50%. Especially you go to Upper Hill here, you go to here Westland, occupancy is about 40-50%. Another bigger mistake came, the government entered into the same market. Rather than making the market better, they made the market worse. Today, I think last year, when I was reading the report by House Consult, they are saying the return of real estate in Nairobi, or in Kenya for that matter, is about 5.7%. 5.7% is only about 1% higher than the inflation rate. And so, there is a lot of things that we can do. And that is why I was happy when the chairman said the housing circle needed to diversify from just the issue of selling, and if we can go to the market of doing the washing, the washing company, the service company, that we can service all those buildings. And also, we can go to a market that I want to do major repairs in my house, that the housing can be able to facilitate that. Maybe at the end of the day, we can get a better return when it comes down to it. And so, my dear brothers and sisters, I will send the notes. Those were a few comments that I needed to make. Thank you, and God bless you.